Michael said we sort of hit that high pretty early, then we faded, and at the end we sort of came back a little bit. What do you think was really driving the general market?
Well, we did see the Aussie market up by 0.3%. It was disappointing in comparison to what's happened on offshore markets over the last couple of sessions, which has been quite bullish, while the Australian market has been away. Now, this is the intraday graph behind me, and you can see that it doesn't paint quite a rosy picture. We did see those gains from the morning deteriorating throughout the afternoon. But if you have a look at it sector by sector, it tells a very different story. The two biggest areas on the Australian market are the financial sectors and the material sectors. So if we have a look at the intraday graphs of both these areas, well, you'll see that the financial sector held up fairly well today. You can see that we didn't see that decline that we saw in the overall index in terms of the financial stocks, but where the huge impact came from were the material stocks. We have a look at the material index. This is the material index over the day, and you can see just how it deteriorated, and that really impacted on the market. We did see headlines coming through from Reuters, and those headlines out of China. We know how sensitive the material sector is to headlines coming out of China. If we have a look at those Reuters headlines coming through in the afternoon saying that China is looking to eliminate 7.8 tonnes of steel-making capacity in 2012. It's looking to close about 700,000 tonnes worth of copper capacity over 2012, and also 270,000 tonnes of aluminium capacity over 2012. So naturally those material stocks were heavily impacted. We have a look at Fortescue, which of course is a pure iron ore play. It was one of the biggest movers of the session, down by 2.2%. We have a look at how that aluminium capacity impacts on stocks like alumina. Well, we did see alumina down by 1.3% over the session, and copper, if we have a look at Oz Minerals, it came out with a pretty good production report, and the stock was actually up as much as 3.5% during the session. But by the end of by the close of the market, we actually saw the stock looking quite flat. In addition, we also saw some numbers coming out of South Korea. First quarter growth numbers slowing down to 2.8%. That's the slowest level that we've seen in 2 years. So those headlines coming out of China really making quite a heavy impact on the material sector, and that of course has a big impact on the Australian market. Some heavy selling in terms of the SPI futures contracts today.
Taking a look at what expectations for the broader market, but in particular seeing where a lot of the investment flows and trends are, and as we've been talking about for some time, the search for yield, very much the case. You look at Telstra, I think what closed above or hit $3.50 the first time since August 2009.
Telstra did have a good day. Let me just bring up the 2-year chart for Telstra, and you can see just what the chart looks like, and it's certainly looking very good. But this is all about the drive for yield. We know that there are expectations of a rate cut next Tuesday. We're seeing investors positioning themselves ahead of that rate cut. And if we have a look at market expectations, really pricing in a more than 90% chance that we're going to see a 50 basis point cut over May and June. And certainly investors are looking for yield, and that's been good news for a stock like Telstra. We saw the highest level that we've seen for Telstra shares since late 2009, and also the banks having a good day. We're seeing some strong yields on the banks, and we've seen this trend over the last few weeks. In fact, if we have a look at monthly performance, Telstra up by 9% over the last month, and the banks up around about 4 to 6% over the last month. So that push for yield certainly continues. But I guess what investors have become wary of is looking at historical yield, because if we have a look at historical yield, we know that the market is expecting downgrades and cuts to dividends as well. And one prime example that we saw very relevant today was Seven West Media. If we have a look at the historical yield for this stock, it's around about 15%. But then if you have a look at the share price, of course, down by 40% over the past year. So a lot of pain for investors if they're just looking at historical yield. And you can see the same type of thing with the retailers. A stock like David Jones, a yield of 10%. Yes, it looks very attractive, but over the last 52 weeks, the stock price has lost about 50% in value. And you're seeing the same type of thing with Myer, with a historical yield of about 9%. So I think investors, they are looking for yield, but more importantly, they're looking for earnings growth as well. So they're chasing those companies in those areas that have earnings growth or are likely to have earnings growth as well as yield. And that's stocks like Telstra. They're looking at growth strategies through NBM. So Telstra shares well supported. And if we have to have a look at the banks, the expectations around the fall in interest rates should be good news for recouping margins, and hopefully a higher demand for domestic loan growth as well in terms of the housing market. So the banks are being well supported there as well. So I guess the market looking for yield and chasing yield, but a little bit careful of historical yields and wanting to see those yields being underpinned by some growth strategy and some strong cash flow.
Media off by 4% as well. Do you see this as a a broad media sector issue that's really been highlighted not just by Seven West Media today, but by 10 Network a little while ago.
We saw 10's results out earlier this month, and we saw first half profit down by 70%. And when you follow that up with Seven West Media coming out to say that ad revenues and the ad market remains quite weak, you are naturally going to see the other media stocks being impacted. I think Rick came up with a really good point, and that's the issue of debt. Debt's a fantastic thing when the business is doing well because it accelerates growth. But when the business isn't doing so well, it really puts a dampener and it makes it quite difficult for the company. And we are seeing that in terms of Seven West Media. But I think what the market was most concerned about here was the fact that while weaker ad markets were being cited, we're seeing high costs in that television area as well, implying around about $29 million worth more of costs in that area. And if we have a look at free-to-air television, this makes up the bulk of Seven West Media's earnings, 61% of EBIT compared to about 28% coming through from the likes of the Western Australian newspaper, and then about 8% from magazines. So altogether, not a good result for Seven West Media today, especially on the footsteps of 10's result earlier on this month, and certainly the other media stocks being sold off in sympathy as well. But Seven West Media, terrible session. It was down by about 15% for most of the session, but by the close down by a massive 23%. So the market really losing confidence in that downgrade, which flowed through, of course, after market closed on Tuesday ahead of that break in the week.
All right, guys.